Okay, so you want to become a gold miner. Gold is trading near record highs, around $4,000 an ounce, and something primal kicks in when you imagine pulling that metal out of the ground yourself. But here's the strange part. The higher gold climbs, the more people rush in, and the more people discover the oldest truth in mining. It is astonishingly easy to spend more money digging for gold than the gold you find is worth. By the end of this, you'll understand the three completely different ways to mine gold, what each one actually costs, why a record gold price doesn't guarantee a profit, and why in every gold rush in history, the people who reliably got rich were usually not the miners. Let's start with the smallest scale, the one anyone can enter, recreational prospecting. This is the pan and sluice world, the person standing in a creek, swirling gravel in a pan, or running a metal detector across old gold fields. The entry cost here is genuinely low. A basic prospecting setup, a pan, a sluice box, a shovel, runs a few $100s. A serious metal detector built for gold can run a few thousand. And you need somewhere legal to dig, which usually means either public land where recreational prospecting is allowed or a mining claim. That word, claim, matters. In the United States, a mining claim gives you the right to extract minerals from a specific patch of land, often federal land. You can stake your own claim where claims are permitted, or buy an existing one, and prices for small placer claims are surprisingly modest, sometimes only a few $1,000s, because the claim is a right to try, not a guarantee of gold. And here's the reality of the hobby math. If you spend $3,000 on a good detector, and gold is worth roughly $130 a gram, you need to find over 20 grams of gold just to break even on the machine. That's achievable for a skilled prospector, working good ground over a season or two. But most hobbyists never recover their equipment costs. They do it for the thrill, and any gold is a bonus. It's worth being clear-eyed about the odds here. Panning a stream recovers tiny flecks. A full day of patient work in decent ground might yield a fraction of a gram. The romantic image of pulling a fat nugget from a creek is real but rare, and the flecks you actually find, weighed against the gas you burned driving to the site and the gear you bought, almost never add up to a profit. What the hobby reliably delivers is time outdoors, the thrill of the hunt, and the occasional genuine find that keeps people coming back for decades. Interestingly, at this scale there's a hidden edge. A beautiful natural nugget or crystalline gold specimen can sell for well above its melt value, sometimes 20 to 50% above spot, because collectors pay a premium for rarity and shape. So the hobbyist's best hope isn't volume, it's finding something beautiful. And even that comes with a legal layer people forget. Prospecting is heavily regulated. Where you can dig, whether you can use motorized equipment in a waterway, and what environmental rules apply all vary by location and are strictly enforced. Dredging a stream without the right permits, or working a claim you don't actually hold, can bring fines that dwarf whatever gold you'd recover. The paperwork and the permissions are part of the real cost of entry, even at the smallest scale. Now let's step up to the middle tier, the small commercial operation. This is where you stop panning and start moving serious dirt. Here you're buying real equipment, an excavator, a wash plant or trommel, to process gravel, water and recovery systems. The numbers jump immediately. A small to mid-size excavator can run $60,000 used to over $400,000 new. A complete small gold mining setup, wash plant, excavator, water system, recovery equipment, commonly runs somewhere in the range of $150,000 to $400,000 in total investment. And that's before you've paid for fuel, labor, permits, and the claim itself. This tier is a genuine business, and it has to be run like one. You're now managing fuel bills, equipment breakdowns, the wages of anyone helping you, and the constant maintenance that heavy machinery demands when it's grinding rock and gravel all day. A single major repair on an excavator or wash plant can erase a month of gains. And unlike the hobbyist, you can't simply walk away when the gold gets thin, because you have capital tied up and costs that keep running whether or not the ground is paying. This is where the concept that governs all of gold mining comes into focus, and it's the single most important idea in the entire business: cost per ounce. It doesn't matter what gold sells for if it costs you more than that to get it out of the ground. The large mining industry measures this with a figure called All-in Sustaining Cost, or AISC, which captures the true cost of producing an ounce of gold, including mining, processing, labor, and sustaining capital. For the global gold industry in 2026, that AISC averages somewhere around $1,300 to $1,400 per ounce. So a big, efficient mining company producing an ounce for $1,350 and selling it near $4,000 is making a very healthy margin right now. That's why gold miners are thriving at today's prices. It also explains why mining company profits swing so violently. When the gold price is well above the cost of production, as it is now, the margin is enormous, and the whole industry booms. But that cost floor of roughly $1,300 to $1,400 an ounce doesn't move much, so if gold were ever to fall back toward it, those fat margins would vanish quickly. The miner never controls the price of gold. They only control, at best, their own cost of pulling it out. Everything else is set by a global market that answers to inflation, interest rates, and fear. But here's the catch for the small operator. Your cost per ounce is almost always far higher than a big mine's, because you lack their scale and efficiency. A profitability calculator for small operations lays it bare. Your revenue is grams of gold per hour times the price, and your cost is the hourly expense of running your equipment and paying yourself. If you're only recovering a fraction of a gram per hour and burning fuel and labor the whole time, you can be underwater even with gold at record highs. The metal in the ground doesn't care what the spot price is. What matters is the grade, meaning how much gold is actually in each ton of material you process, and how efficiently you can extract it. Low grade plus high operating cost equals a loss, no matter the headline gold price. Now the top tier, industrial mining. This is the world of major companies, deep mines, and open pits, and the numbers become almost incomprehensible for an individual. Developing a mid-sized gold mine can cost anywhere from $500 million to over $1 billion in capital expenditure before it produces a single ounce for shafts, processing plants, infrastructure, and permitting. This tier is simply not accessible to an individual. It's the domain of publicly traded corporations, geologists, and enormous financing. The reason it exists is that at industrial scale, even ground with just a few grams of gold per ton, invisible to the eye, can be mined profitably because the operation processes staggering volumes of rock efficiently. An open pit running 4 grams of gold per ton is a real business at that scale, and a hopeless one for a person with a shovel. There's a lesson buried in that contrast that applies to every tier. The thing that determines profit isn't how much gold exists. It's the relationship between grade, scale, and cost. A giant company wins on scale and efficiency even with poor grade. A small operator can only win with genuinely rich ground because they lack the volume to make thin ore pay. And the hobbyist wins, if at all, on rarity and beauty rather than quantity. 3 completely different business models, all chasing the same yellow metal, each viable only under its own narrow conditions. So let's connect the tiers and answer the real question. Can you actually make money mining gold? The honest answer depends entirely on which version you mean, and on that ruthless cost per ounce math. As a hobbyist, expect to spend more than you find and treat any gold as a memento. The joy is the point, not the profit. As a small commercial operator, you're running a real business with real risk, and your success hinges almost entirely on 2 things: the grade of your ground and your operating efficiency. Find genuinely rich ground and run lean, and today's near $4,000 gold can make you real money. Work poor ground, or let fuel and labor costs balloon, and you'll lose money faster than at almost any other price in history, because you spent heavily chasing a metal that wasn't there in high enough concentration. And that leads to the deepest truth about gold mining, the one every gold rush has taught and every generation forgets. In the California rush of 1849, most of the miners who scrambled for gold ended up broke or barely even. The people who got reliably rich were the ones selling shovels, tents, food, and supplies to the miners. The merchant made money on every miner, whether that miner struck gold or not. The modern echo is exact. Today, the companies selling wash plants, excavators, metal detectors, and mining claims profit from the current gold rush, regardless of whether their customers ever find an ounce. The claim seller gets paid whether the claim has gold or not. The equipment dealer gets paid whether your grade is rich or barren. So if you're drawn to gold mining right now because the price is high, understand what you're really weighing. The high price is genuinely real, and for an efficient operation on good ground, it's a genuine opportunity, the best in decades. But the high price also inflates every cost around you and lures in competitors, and it does nothing to change the fundamental equation. Gold mining is only profitable when the gold you extract is worth more than everything you spent to extract it. That sentence sounds obvious, and it is exactly the thing that has bankrupted prospectors for 200 years. The gold is real. The record price is real. But the ground either has enough of it or it doesn't. And no amount of hope and no headline about gold at $4,000 can put gold into rock that never had it. The miner bets on the ground. The person selling the shovel doesn't have to bet on anything at all. That, more than any nugget, is the enduring economics of gold.